Hello, this is Eric Thompson. I am president of Peerless Wealth. We are an SEC registered investment advisory firm located in Columbus, Ohio. Thank you for tuning in. I knew I'd get you to with this title. Public versus private, is sexy better? You might know where I'm going with this, but there's a lot of buzz around private equity and also private credit in the last few years. And as an investor, it can be alluring to be sort of part of something that the average investor can't get, maybe because it feels like you're in a club or you reached a minimum or that sort of thing, or you have access to deals that, like SpaceX, for an example, is one, OpenAI is one. And those aren't public yet. And so to get access, you have to be with like a venture capital fund, which is an example of a private equity fund. As a registered investment advisor, I have access to most of these vehicles that I could put clients' money in or recommend to clients. I've been doing this for 20 years and I haven't made a big move to this because I'm not convinced that they do much better, but I am convinced that they have a lot of disadvantages. So I like the public side, even though it's not a fun story you can brag about at a cocktail party. It often works out better. So I'm gonna cut to a comparison here, and it's a nice visual, and it'll show sort of the differences between public and private. So on the left is public. So public investments are things that are on the stock exchange, the S&P 500, Procter & Gamble stock, various mutual funds and ETFs. Daily liquidity. You not only know what it's worth every day, even every minute, but if you want your money, you can get it. And you know what you're gonna get for it. That's what liquidity is. Doesn't mean it won't fluctuate in value, but you can get it if you need it. Private investments, limited liquidity. By definition, you're investing often with a pool of other investors into companies that are not yet public. They're privately held. And as such, the only way you know what they're worth is if you get an appraisal, and they only do that every so often. And if you want your money back, you typically have to wait, oftentimes years, until they sell the companies they're in and have a liquidity event. So again, on the public side, highly regulated. I have firsthand experience of this, not only managing an SEC registered and regulated advisory firm, but also sub-advising an ETF. There's a lot of regulation, constant background checks and due diligence, and it's all to protect the investor. Private investments, you don't always get that. Financials. Public companies are required to have audited financial statements. Private, not always. So it's easier for them to sort of exaggerate or cook the books. Public investments, low fees. You can buy an S&P 500 index fund for virtually nothing. 10 cents or $10 on a $10,000 investment. Private investments, this is probably the biggest reason why I don't do more of these. And the fees are high. Instead of paying 1/10 of 1% a year in something like an index fund, you'll pay oftentimes 2% a year and as high as 20% of the profit that the fund manager makes. So if the private equity company is buying a bunch of privately held plumbing companies, and they're gonna go in there and they're gonna upgrade the technology, they're gonna upgrade the marketing, they're gonna upgrade the accounting, and they're gonna make it bigger over a few years and better and worth more, and then sell it, that could take 5-6 years, and they often keep 20% of the profit plus the management fee. And they really have to outperform a lot more to justify a lot of the fees. So on private investments, instead of daily liquidity, there's limited liquidity. And we are going through an example just recently, occurring as we speak, to how this limited liquidity can backfire. Private credit, unlike private equity, private credit is basically pooling private loans that are not publicly traded bonds. And it's a lot of companies that maybe couldn't get traditional financing. Maybe they are paying 9 or 10% interest instead of the 6 or 7 that traditional public funds are paying. And there's a reason why they have to pay more, because they're not as sound. But a lot of investors are saying, hey, I'd love 9 or 10. And these things have a good track record, so they've been putting a ton of money into these private credit funds. I have not for any of my clients, and we're finding out why. These private funds do not let you take the money back out more than Most of them, you can only get to about 5% of your investments every quarter. And there's been some strains on these loans and some default rates recently, not huge, but it's caused a bit of a run on the bank to where these investors are like, well, I want to get my money out before it gets worse, and I don't want to be last when the music stops. And you're seeing some big strain on these right now that you're not seeing in the public debt market. So that's a recent example of the disadvantage of some of these liquidity gates on these private funds. Again, down the list, public, full transparency, easy access, low minimums. A lot of private funds most of them, you have to be an accredited investor, which means you have to have a liquid net worth of at least $1 million, oftentimes $5 million, depending on the deal. And that's there to protect sort of the average investor from losing all their money. With public investments, you can get in for literally $10. Taxes, the tax returns on private companies, you're oftentimes structured as a limited partner, and the manager is a general partner. And you get a K-1, and that K-1 is usually after April 15th, so it can make taxes a little annoying. Probably my other big reason why I prefer public over private is the last one, long-term data. Public companies are valued literally every day. So we can go back in time very easily and say, how did XYZ ETF or XYZ mutual fund or this group of blue chip stocks do over a certain period of time? And I can get the exact historical performance. Private's a little tougher, and they're not priced every day. How do we value them? So it becomes very complex. That said, there is data on this. There's a company called Cambridge researched, I think, the 1,300 largest private equity firms over the last 25 years, and they concluded a long-term average of 13 to 14% a year versus maybe 10 to 11% on something like the S&P 500. Because of that, a lot of proponents of private equity, even a lot of social media influencers, I saw Tony Robbins recently pitching this and then found out that he has an interest in the fund he was pitching, shocker. They're using that data to pitch it. The problem is it's hard to verify that data because it's private. And I believe that it's a little bit overstated. First of all, the fee structure that large institutions can get in at is lower than what average Joe can get in at. Secondly, I believe there's survivorship bias to where a lot of these companies that didn't make it and that sort of closed up shop, disappeared, aren't included in that 25-year average. Long story short, all these red X's that I showed, you might be thinking, well, why in the world would anyone want to do this private equity? Well, again, maybe higher returns, 13 to 14%, if you believe the data. I think more than that, it's the exclusivity. It's an investor feeling like they're part of a club and they're in on something that somebody else can't get. But my conclusion is, for most people, even millionaires, multimillionaires, I think the public is better. I just think it's more transparent, lower fees, and more predictable. That said, there are a few situations, a few things I've seen come across my desk that are more investor friendly. They're not fully liquid like public, but they're technically private. One that invests in real estate that has a really good track record from a really good company and a reasonable fee structure. And the other one that invests in pre-IPO deals. And yes, there's some SpaceX in there, and so there's OpenAI. I have done that on a limited basis, but the returns on the pre-IPO fund, honestly, are not much better over the last 10 years than a typical small cap public fund. So I'm not sold on it, but that's why you have a fiduciary advisor to vet these things out. So I hope you learned something, and we will see you next time.